Now we are moving to the best part of the basics lessons of income tax, and I call it as the preliminary contents. Okay, so let us invite your attention to the practical scenario. In practice, when a client approaches us for computation of income and filing of income tax returns, we follow certain path, a certain formula for the income tax assessment and return filing. The same specific path or formula can be applied for learning the computation of income and charging of income tax and all other aspects. So let us follow the same path while you learning for your examination. Let us see one by one. When a client approaches us, we will ask certain questions and we will note that questions, and after noting that we will compute his income and compute his income, compute his tax and file the return. Okay, so let us see what are the steps. First of all, we categorize that particular person into a head which is known as person defined as per the income tax act. First of all, we categorize that person under the head person which is defined under the income tax act. See, it is not about the gender discrimination or gender specification. It is about the person specified by the income tax act. Income tax specifies various categories of persons which will be learned later. Okay. Then we will ask what is the residential status of that person. Residential status, whether he is resident or non-resident. The residential status is based on the number of days a person stay in India. It is not based on the citizenship. So we will ask his residential status, whether he is resident or non-resident. About the residential status will be discussed later separately. Okay. Then we will ask the year of earning his income, for which year the income belongs to. Okay, then we classify, after collecting the details of income, we classify the total income under different heads. We already discussed the 5 heads of income as per the income tax act. Income from salary, income from his property, profit and gains from business or profession, capital gain, income from other sources. And after that, we will calculate the total income of that person. From total income, we claim deductions. It will be studied later. There are certain sections which specify deductions from income, and we also apply exemptions. There are certain exempted income. What is the difference between deductions and exemptions? We will study. Okay. Then after applying the deductions and exemptions, we arrive at the taxable income, on which we will apply the rates of tax. So this is the basic formula for computing the income tax. Repeating once again, first we will categorize that person, particular person, under the head person specified by the income tax act. Then determine his residential status, whether he is a resident or non-resident. Then ask for the year for which the income is assessed. His total income will be classified under different heads. Calculate the total income, then claim deductions, apply exemptions, and finally we arrive at the taxable income. This is the basic formula for computation of income tax act. And why we are dealing with this aspect? Because see what I am writing, because income tax is levied. Income tax is levied on taxable income. Income tax is levied on taxable income of a person earned during the previous year. That is the year of earning income. See, there are 3 points: taxable income, person, previous year. Because of this explanation given by the Income Tax Act, we are dealing with these preliminary contents, which is the best part of basics lessons of Income Tax Act. So we will deal one by one. The person, who includes in the person's category. Residential status will be studied later. Year, concept of year under Income Tax Act. Then what difference between deductions and exemptions, and a small formula for computation of the taxable income. So let us analyze the concept of person as defined by the Income Tax Act 1961. Section 2. So at the very outset, I'll give an information. Section 2 of every act deals with definitions. So even if it is a Companies Act or any other act, Section 2 of every act deals with definitions. So as per Section 2, subsection 31 of Income Tax Act, it defines a person as an inclusive definition. That means person includes these categorization. It is not an exclusive definition. An exclusive definition defines the concept very clearly, but this person is an inclusive definition which includes the following categorization. There are two types of definitions, inclusive and exclusive. Okay, so the definition of person can be categorized into an inclusive definition. So person includes, let us see one by one. Individual. Person includes individual. Individual means a natural human being. Male, female, minor, persons of sound mind, even persons of unsound mind can be categorized for the purpose of taxation. You may think how an unsound mind can be considered for taxation, because as per the Contract Act, a contract with an unsound mind person is not valid. It is void ab initio. But for the purpose of taxation, even unsound mind person can also categorize in the category of individual and can be charged for the income tax purpose. So first of all, individual, the natural human being, then Hindu undivided family, HUF. So what is the concept of HUF? HUF is constituted based on the family setup. For example, my father, my mother, I, my wife. We together can constitute a business setup which can be registered as Hindu undivided family. These are the members. They contain the members of a family from common ancestors. Common ancestors. In Malayalam it means Poduvaitla Thai. Okay. But members of family from common ancestors, which includes wife and unmarried daughter. Let us underline this word. Wife and unmarried daughter. So if a daughter is married, they cannot be the member of an HUF family. Okay, so HUF, Hindu undivided family, is also part of the concept of person, and the members of HUF are called as co-partners. So second category is the Hindu undivided family. They contain the members of a family from common ancestors, which includes wife and unmarried daughters, and the members are called as co-partners. Then third categorization is the company. Company includes Indian company registered in the Companies Act 2013 or any other previous act, and also the foreign company. Then firm. For the term firm, as per the Income Tax Act, includes LLP as well, limited liability partnership. So whenever I say firm, it includes LLP as well. Then a new term, AOP or BOI. AOP, Association of Persons. Person includes these categorization. So if these different categories join together for a common purpose, it is called as association of person. Okay. For example, for an exhibition, for conducting a seminar, these persons can join together. In the same way, body of individuals, it is association of individuals only. So they can come together for a common purpose. So association of persons, body of individuals, then local authority, that is the municipality, corporation. Okay, then the last category is the artificial juridical person. These are the artificial person. There are other artificial persons in the previous category. Company is an artificial person, firm is an artificial person. But here, artificial juridical person includes the artificial persons other than these categories. For example, university. Okay, for example, university, then clubs, etc. So these are the artificial juridical persons. So the category of person as per the Income Tax Act, as per section 2, subsection 31 of Income Tax Act, can be categorized as individual, Hindu undivided family, company which includes Indian company as well as foreign company, firm including LLP, association of persons, body of individuals, local authority, and artificial juridical persons. Okay, this is the concept of person. So I already said, first of all, we analyze when a person approaches us for the purpose of income tax return filing, we categorize that person under that person specified under section 2 subsection 31 of the Income Tax Act 1961, whether he is an individual, HUF, company, AOP, BOI, local authority, etc. etc. So this is all about the concept of person. While analyzing the concept of a person, we have to be familiar with another term, which is the most important term, known as assessee. Okay, so assessee is as important as the term person. Often, while discussing income tax matters, we emphasize on the term assessee. And most cases, assessee and the term person are interchangeably used in the Act. And there are also generally asked question whether every person is an assessee and all. Okay, so we have to deal with all these situations, and before going to the definition of assessee given by the Act, I am critically examining what is the concept of assessee. We can take a very different route for the analysis of assessee by critically examining each content of assessee. So for the purpose of discussion, I am segregating the term assessee into three. First one is a normal assessee, second one is a deemed assessee, and assessee in default. Normal assessee, deemed assessee, assessee in default. So who is a normal assessee? Let us see one by one. I have written three conditions which is provided by the Act. Okay, so if a person satisfies any of the three conditions, he can be termed as a normal assessee. So let us discuss one by one. The first condition is any person liable to pay tax under the Act. If a person is liable to pay tax under the Act, that person is treated as assessee. In that case, that person is assessee. Okay, so liable to pay tax. For example, I am an individual. My category of person is individual. If my income exceeds 3 lakhs, my taxable income exceeds 3 lakhs, I have to pay tax. That means I am the person who can be categorized as assessee. Okay. Then the second condition is any person liable to pay any other sum under the Act, not the tax. Any person liable to pay any other sum under the Act. What is called any other sum? There may be interest, penalty for non-compliance of the provisions of the Act. If I am paying an interest or penalty, even though I am not liable to tax, in certain cases I have to pay interest or penalty. In that case also, I have become the assessee. So not only the person who is liable to pay tax, if he is liable to pay any interest, penalty, any other sum other than the tax, is considered as the assessee. So these are the first two conditions. Repeating once again, any person liable to pay tax under the Act. Okay, then any person who is liable to pay any other sum under the Act. These are the two conditions, primary conditions for satisfying a person to be considered as assessee. Okay, I already given an example in the case of individual. Take an example in the case of firm. In the case of individual, there is a basic exemption limit. The taxation system is progressive. But in the case of a firm, there is a straightforward taxation rate. Okay, say 30%. So in the case of a firm, if the firm earns profit from business, okay, then the firm is liable to pay tax. In that case, the firm becomes an assessee. The firm is a person and an assessee. Okay, then moving to the third condition. After reading the first two conditions, you may arise two questions. First question is, sir, I am not liable to pay tax. My income is below my exemption limit. Whether I can be treated as assessee. So, not liable to pay tax. Not liable to pay tax or any other sum. Whether I can be treated as assessee. Okay. Then the second question is, So I already paid my tax, whether I am an assessee still. Okay, so I already paid my tax, whether I am still an assessee. Okay, so answering to these two questions, we should critically examine the third conditions. While examining the third conditions, I need some time because there is an explanation about income of other person also. So it will take a little bit time. I will explain in detail later. Let us examine the third condition. See, third condition, every person in respect of whom, every person in respect of whom any proceedings have been taken by the assessment. Any proceedings have been taken for the assessment. If the income tax department, who will assess? Income tax department. What is the purpose of our act? Assessment of income. Okay, so if the income tax department has taken an initiative for the assessment of income, loss, or refund. I will explain that. Refund. Such persons can also be treated as assessee. Okay, so every person in respect of whom any proceedings have been initiated by the department. Okay, so after paying my tax, I already paid my tax, then I will submit the income information of my income, my deductions, exemptions, all kinds of details with regard to income tax matters. I will submit these details to the department, which is known as filing of returns. Okay, after filing, the income tax department will assess the information whether I have complied with the provisions of the act. Okay, so that is what is called as assessment of income. Then also I will be treated as assessee. So the answer to the question whether a person who paid tax can be treated as assessee, still he can be treated as assessee if the department has initiated any proceedings for the assessment of income, for the assessment of loss. If I incurred loss from the business and you not pay any tax, but the department will look into whether that loss is as per the provisions of the act, whether I have complied with the provisions of the act. If such assessment takes place, still I can be treated as assessee even though I am not liable to pay any tax or any other sum. That is the third point. So I think it is clear to you, even if a person is not liable to pay tax or any other sum, even if the person is already paid tax, he still can be treated as an assessee if the department has initiated any proceedings for the assessment of his income, his loss, refund matters, etc. Moving further a little bit, I am talking about that person only. Some persons or some assessees can be treated as assessee for other persons' income also. This is a new concept. Some persons or some assessees can be treated as assessee for other persons' income also. To analyze this matter, we should analyze the concept of deemed assessee. Okay, so let us have a discussion on the deemed assessee. What is the term deemed mean? In Malayalam it is known as kanakkakuga. So he is deemed as, is considered as assessee, though really he is not assessee for that income. Okay, so let us have an example for this. The first example is legal representative of a deceased person. If for example Mr. A, who earned income for example 10 lakhs during the year, died before the filing of returns. Okay, even though he is no more, the income of that person to be assessed. In that case, the department will assess his income in the name of his legal representative. In that case, his legal representative can be treated as deemed assessee. His legal representative may be earning his own income. He may be filing his returns based on his income, and he has to club the income of the deceased person also. So this legal representative can be treated as deemed assessee. Okay, then Another example is agent of a non-resident. If a non-resident person, we will discuss who is a non-resident. A non-resident person doing business in India is not capable of coming to India. So he may appoint some persons and give power of attorney and can be treated as the beneficial owner of that business. Okay. In such case, such agents will operate the business, uses that income for his own benefit, and in such cases the agent can be treated as the deemed assessee. Is the assessee on behalf of the non-resident's income, even though the income is for the non-resident. The agent can be treated as the deemed assessee, and that income will be taxed under the head the deemed assessee on behalf of the non-resident in the name of the agent. Okay. And the next very classical example, legal guardian of a minor. Okay, we all know minor. There is an exception to that in the case of minor. We will study later. If a minor earns income, a minor cannot be assessed to tax, and in that case, the income of the minor will be taxed under in the name of the legal guardian. The legal guardian can be treated as the deemed assessee. Okay. Another example we dealt in the previous session. Unsound mind. I explained about the person, and the person includes individual. The individual may include unsound mind. Okay, person of unsound mind, and if that unsound mind, the person who is in the status of unsound mind earns income, it will be taxed in the name of his legal guardian, and the legal guardian become the deemed assessee. So this is the concept of deemed assessee. Why we are discussing this? Because we have to carry over this concept to the third condition. We have to carry over this concept to the third condition. Let us once again express the third condition. Every person in respect of whom any proceedings have been taken for the assessment of income, loss, refund of such person or on behalf of another person. That means he will be deemed to be an assessee of other person, still he is treated as assessee. So this is the concept of normal assessee. Repeating once again, the assessee for the purpose of critical examination is classified into three. Still one discussion is pending. Normal assessee, deemed assessee, assessee in default. What is the concept of normal assessee? If a person is liable to pay tax under the act, he is treated as normal assessee. If a person is liable to pay any other sum under the act, for example interest or penalty, still treated as assessee. Even if he pay tax or he is not liable to pay tax, still he is treated as assessee. Any proceedings have been initiated by the Department of Income Tax for the assessment of his income, of assessment of his loss, or in the case of refund, not only his income loss refund, in the case of other person's income loss refund also, because there is a concept of deemed assessee. Deemed assessee is also the part of, or also can be considered as the part of the term assessee. Then the third discussion is about assessee in default. See, default. Okay, failure. So who is assessee in default? A person, still we are starting the term assessee from the term person. That's why discussion of person lead to discussion of other term, that is called as assessee. Okay, so a person who has not fulfilled any statutory obligation, under the act is termed as assessee in default. Repeating, a person who has not fulfilled any statutory obligation under the act is called assessee in default. Example, payment of tax, he has not paid any tax. Filing of return, he has not filed any returns, income tax returns, he is called as assessee in default. So these are the three categorization of the term assessee: normal assessee, deemed assessee, assessee in default. Okay, in that case, whether every person is an assessee? Definitely every assessee is a person, because the term assessee starts from the term person. Any person, every person, a person. Okay, but to become an assessee, a person must satisfy these conditions. Therefore every assessee can be person, but every person may not be an assessee. Okay, this is all about the concept of assessee. Then we will look into, the definition given by the Act. Now let us discuss the term assessee as defined by the Act. Section 2, subsection 7 of Income Tax Act defines the term assessee. We already discussed in detail. Let us examine what is specified by the Act through its definition. Okay, assessee means any person who is liable to pay tax under the Act. Any person who is liable to pay tax under the Act, any tax or any other sum. Okay, or any other sum. So assessee means any person who is liable to pay tax or any other sum under the Act, and includes. In the previous session, we already discussed the types of definitions. There are inclusive definitions and exclusive definitions. Inclusive definition gives the term includes. We can include in the definition. Exclusive, as such, it gives the meaning. Okay. Here, the definition of assessee has two types of content of definition. One is the exclusive part and one is the inclusive part. See, the exclusive part is assessee means, that is the exclusive part. It narrates who is an assessee. Okay. Any person who is liable to pay tax or any other sum under the Act. This is the exclusive part of the definition, and includes, that is the inclusive part. Okay. So, and includes. Who includes? Every person respect of whom any proceedings have been taken for the assessment of. See, his income or income of any other person deemed assessee. Okay. His loss, the loss sustained by him or loss sustained by any other person deemed assessee, and refund due to him. So what is refund? If I pay tax more than the required amount, if excess amount has been remitted to the department than the required, that excess amount will be refunded by the department, including the interest part. Okay. That excess part is known as the refund of that excess part. That is called as refund due to the assessee. So, if for that purpose the income tax also assess my income, whether I am eligible for the refund. So the assessment will take place. If the department makes assessment of the refund due to me or income of any other person, still I can be treated as assessee. So this is the inclusive part. Every person respect of whom any proceedings have been taken for the assessment of his income, income of any other person, the loss sustained by him or the loss sustained by any other person, refund due to him or the refund due to any other person, and see the most important part, every person deemed to be assessee, to be connected with the third condition. Okay, every person deemed to be deemed assessee is also part of the term assessee. Then every person who is deemed to be the assessee in default. So the person who is in default, assessee in default, who has not obliged with the statutory obligations, is or can also be categorized in the term of assessee. So this is the inclusive part, and this is all about the term assessee. To conclude, once again, every person may not be an assessee, but every assessee is a person. Okay, thank you. So we learned the concept of person, the concept of assessee. I'm moving to the next preliminary content, the concept of year for the purpose of taxation. So, as per the Income Tax Act, year refers to the financial year. We all know the financial year starts from 1st April of a year and ends on the 31st March of the next year. So, for the purpose of income tax assessment, year refers to financial year. But for assessment of tax and further procedures, for taxation purpose, the financial year is segregated into two, or viewed in two perceptions. One is the previous year, second is the assessment year. So for the purpose of taxation, financial year is classified or viewed in two ways. One is the previous year, the other is the assessment year. Repeating once, year as per the Income Tax Act refers to the financial year commencing from 1st April of a year and ending on 31st March of the next year. And for the purpose of taxation, this financial year is viewed in two heads. One is the previous year and second is the assessment year. So what is assessment year? As the name indicates, assessment, as the name indicates, it is the year in which the income earned is assessed to tax. As the name suggests, it is the year in which the income earned is assessed to tax. Income earned of which year? Income earned in the previous year. Income earned in the previous year is assessed to tax. So, assessment year means it is the year in which the income earned by the person in the previous year is assessed to tax. So, assessment year means the year in which the income is taxed. The year in which the income is taxed. It is defined under section 2 subsection 9 of the Income Tax Act 1961. So what is assessment year? The year in which the income is assessed to tax. Assessment is the purpose of the act. Okay. So that year consists of, assessment year consists of a period of 12 months. Okay, consists of period of 12 months starting from 1st April to 31st March. So this is all about the assessment year. So assessment year is a period of 12 months consisting from 1st April, commencing from 1st April to ending on the 31st March. So what is about the previous year? Previous year, this is the assessment year. Income tax authority is more focuses on the assessment year because the purpose of the act is to assess the income and compute the tax. So Income Tax Department focus on the assessment year, and the year preceding the assessment year is called the previous year. Is called the previous year. In other terms, or in other way of expressing previous year, it is the year in which the income is earned by the person. It is the year in which the income is earned by the person. And the most important point, it may or may not include a period of 12 months. It may or may not include a period of 12 months. Why this expression may or may not used? For example, if I started a business on 1st April 2019, 1st April 2019, then the financial year, as for the purpose of taxation, year means financial. My financial year is 1st April to 31st March, and there will be a period of 12 months in this case. But if I started my business on 1st October 2019, the financial year is 2019-20, but a period of 12 months cannot be there, will not be there, because my business is started on 1st October. So the earning of income starts from 1st October. So the previous year commences from 1st October in that case. October to March. There will not be period of 12 months. So there are certain situations the previous year may not include a period of 12 months. Two examples are newly set up business. Newly set up business and newly earned income. Newly earned income. In these cases, there may not be a period of 12 months. So this is what is called as assessment year and previous year. Assessment year, the year in which the income earned by the assessee in the previous year is tax, brought into the tax ambit, and the previous year is the year in which the income is earned by the person. Okay, currently our current assessment year is 2020-21. That is the assessment year of which income? The income earned in the previous year of 2019-20. So currently we are relating our taxation matters to the assessment year 2021, the previous year 1920. So this is the concept of previous year and assessment year. Remember, generally, or the general concept of taxation is income earned in the previous year is taxed in the assessment year. But there are certain exceptions. In certain cases, the income earned the previous year is taxed in the previous year itself. That will be dealt in detail later. Now continuing with our discussion with regard to the previous year. What is the general rule? Income of the previous year is assessed to tax in the assessment year. Income of the previous year is assessed to tax in the assessment year. That is the general rule of taxation, assessment of tax. Okay. There are certain exemptions which is provided in the Act to protect the revenue, to protect the interest of the revenue. These exemptions are because the government thinks that some assessees may not be available for assessment, okay, or there will be no assessee left to be assessed. So there are certain instances where the government thinks that the previous year's income to be assessed in the previous year itself. So let us see one by one what are the exception rules, not the general rule, exception rules, which is discussed from section 172 to section 176 of Income Tax Act 1961. Okay, from examination point of view, these are as multiple choice questions. Okay, so let us discuss one by one. The first, section 172 provides shipping business income of a non-resident ship owners. Shipping business income of a non-resident ship owners. Here, what is to be discussed is the owner of the ship is a non-resident person, and the ship is allowed to depart from the Indian port only after payment of tax on the income received by the ship owner. What is the income of the ship owner for carriage? Freight. Okay, so the tax on the freight is to be paid at the very outset of the journey. Then only the ship will be allowed to depart from the Indian port. So in the year of earning income itself, it is subject to tax. This is because the ship owner is non-resident. Okay. Alternatively, he can arrange certain facilities for the payment of tax. Okay, but if he has an agent in India, a representative in India, we already discussed deemed assessee, concept of deemed assessee. Okay, if he has a representative in India, this is not an issue. That income can be taxed in the assessment year. But if there is no such agent or representative, the owner of a ship who is a non-resident and the income received by him should be assessed to tax in the previous year itself, and the departure of the ship from the Indian port shall be allowed only after the payment of tax on the freight. Okay, that is the first point of discussion, section 172 of Income Tax Act. Shipping business income of a non-resident ship owner. Moving to the other areas. In the case of other points, the role of assessing officer comes into play. So you should listen my sentence, the way I express these terms. Okay. Let us listen. If it appears to the assessing officer that a person leaves India with no intention to come back, that is a permanent departure from India. If it appears to the assessing officer that a person intends to leave India with no intention to come back, then that assessing officer will insist such person to pay tax and assess the tax in the previous year itself. Okay, that person voluntarily does not approach the assessing officer, sir, I'm leaving India for permanent purpose, shall you tax? No, that is not the case. Here the assessing officer, he will insist the person who leaves India without an intention to come back to pay the tax and assess the tax in the previous year itself. That is what is discussed in section 174. A person leaving India without an intention to come back, permanent departure from India for any purpose. Okay. So these are the 2 points. Shipping business income of non-resident owners, then person leaving India without an intention to come back, section 172, non-resident ship owner, section 174, person leaving India without an intention to come back. And the third case, section 174 capital A, and AOP, BOI, artificial juridical persons. These are different categories of persons. They constituted an organization setup. For a particular purpose. And it appears to the assessing officer from his examination that after achievement of that purpose, this constitution or this organization will be dissolved. There is no intention of moving it as a going concern. If it appears to the assessing officer that this business setup will be discontinued after achievement of the particular purpose, the income received from that activity will be taxed in the year of earning itself, that is in the previous year itself, and assessed to tax in the previous year. This is what is about section 174 subsection A, AOP, BOI, artificial juridical person formed for a particular purpose. Okay, moving to the next. Persons likely to transfer assets to avoid tax liability. Again, persons likely to transfer assets to avoid tax liability, section 175. Let me say an example. For example, I have a property which is let out for residential purpose or business purpose, whatever. Okay, I am receiving income which is clubbed with my other income also. I am paying tax. My income exceeds 3 lakh. So I am thinking of transferring this property to another person's name, and that person, even if he receives the rent of the property and club with his own income, his personal income, he is not subject to tax. So in order to reduce my tax liability, my intention is to reduce, but the department not use the term reduce evasion, they use the term evasion. So in order to reduce my tax liability, I am transferring that asset. Okay, and if the assessing officer is of the opinion that, from his examination, he is of the opinion that this transfer is to avoid the tax liability, then such income will be taxed under my PAN number, that is per my account number, under my head of income in the previous year itself, because in the next year onwards the property belongs to the other person. Okay, so in that year itself the income will be assessed. So person likely to transfer assets to avoid tax liability, section 175. And moving to the last point, discontinued business. If a business is going to discontinue this year, that is, we are cutting the going concern assumption, we are putting an end to the going concern assumption, discontinuing the business in any year, then at the discretion, I am not using the term in the opinion of the assessing officer, or if the assessing officer from examination it appears that, I am not using that term. At the discretion of the assessing officer. That means if his discretion is to assess the tax in the assessment year, it is as in the assessment year. But if his discretion is to assess the tax in the previous year itself, it is as in the previous year. So at the discretion of the assessing officer, note down, at the discretion of assessing officer, income tax officer, it will be taxed. The income of such a discontinued business will be taxed in the year of earning, that is the previous year itself. Okay, so these are the examples of exemption to the general rule, that the income of the previous year is assessed to tax in the assessment year. So repeating once again, section 172, shipping business income of non-resident ship owner. The ship is allowed to departure from the Indian port only after the payment of tax on freight. Okay, and the persons living in India with no intention to come back. The section 174, if it is appears to the assessing officer that there is no intention, his income will be taxed in the previous year. And if it appears to the assessing officer that the AOP, BO, artificial juridical person constituted for a particular purpose, there is no intention to continue the business, and in that sense, the assessing officer will make them to pay the tax in the previous year itself, and the person is likely to transfer the assets for the purpose of avoidance of tax liability. And if it appears to the assessing officer that this transfer is in order to avoid the tax liability as per section 175, it is taxed in the previous year itself. And to last point, moving to the last point, discontinued business. If the going concern assumption is put to an end and the business is going to be discontinued, at the discretion of the assessing officer, the income of such business will be taxed in the previous year itself. While calculating the total income, we should be familiar with two concepts: deductions and exemptions. Okay, we already discussed how we compute the total income, and one of the content was deductions and exemptions. So both are different. Though both deductions and exemptions bring same effect in the total income, the application part of deduction and exemption are different. Let us see what is deduction, what is exemption, our differences between deductions and exemptions. The term deduction means it is a reduction of money from the total income. See, it is the reduction of money from the total income. So from the total income, we can deduct certain items. Okay, so it is the reduction of money from the total income, and there are two types of deductions. One is the specific deduction, the other is the general deduction. One is the specific deduction and the other is the general deduction. So what is specific deduction? Specific deductions are discussed under each head. From each head certain deductions are available. A classical example, not for the beginners of learning of Income Tax Act, those who are experienced in income tax law. For example, interest on housing loan. While studying, we're dealing with the income from house property, we are able to deduct under section 24 the interest paid on the housing loan. That is an example of specific deduction. Okay, so there are specific deductions which will be discussed under each head, and there are general deductions. These are deductions based on our investment. These are deductions based on our investment. These reductions are dealt under section 80C to 80U. Okay, so this is the part of deduction. It is a reduction of money from the total income. Total income means the sum of the income classified under different heads, the 5 heads. Okay, so this is the reduction part. Then what is exempted income? Exempted income. The income is exempted. That is, exemption means the exempted income. The income is exempt. The income that as such is not considered for calculating the total income. It is as such not considered for calculating the total income. So we will ignore that part. So what is the difference between deduction and exemption? The main difference is, in the case of deduction, it is first considered as part of total income and then it will be deducted. So deduction in deductible income, that is what is called as, it is considered as a part of total income initially and the deduction is available on the later stage. What is exempted income? The income itself is exempted. It is ignored by calculating the total income. That is the main difference between the deduction and exemptions. And section 10 of Income Tax Act deals with various exempted incomes. So students, note down what is deduction, exemption. Deduction is a reduction of money from the total income. It is first considered as a part of total income, then deduction is allowed. Classical example, interest on housing loan. There are specific deductions which is dealt under each head, and general deductions based on the investment made, section 80C to 80U. And exempted income means the income is exempted, totally ignored by calculating the total income. Section 10 deals with the concept of exemptions. So students, we are moving to the last part of our discussion with regard to the basics lessons of Income Tax Act. It is the computation of taxable income. This is a simple format you can use while doing problems, while calculating taxable income for your examination. So let us see what are the ways through which we can compute the total income. Okay. First of all, if you are doing a problem with regard to computation of taxable income, see the category of person the assessee belongs to. The category of person the assessee belongs to, whether he belongs to individual, whether he belongs to HUF, whether he belongs to company, because different taxation system, taxation rates are applicable for each of these persons. So first of all, analyze the category of the person to which the assessee belongs to. And next is the residential status, whether he is resident, whether he is non-resident. because application, the scope of taxation is different for resident and non-resident. Then the year for which the income is taxed. Here for the current year is the current assessment year is 2021, previous year is 2019-20. Now after that, collect all the details of income, and classify under different heads. Okay, if he is an employer and if he is an employee, he receives income from employer, it can be categorized under the income from salary. Rental income, income from house property, profit or loss from business or profession under the head PGBP, profit and gains from business or profession. Okay, profit by way of transfer of asset, capital gain, and all other incomes that are not included in the first four heads can be classified under the head income from other sources. A classical example, interest on fixed deposit of bank. Okay, so collect all the details of income, classify under different heads. The point to be noted is that while classifying or while calculating income from salary, there may be specific deductions that is to be first included and deducted, and exemptions that is to be ignored. So calculating income under each head, see the deductions and apply the deductions, see the exemptions, ignore the exempted income, and calculate and sum, totalize, aggregate the total income received by that person, which is called as gross total income. After calculating gross total income, the general deductions based on investment. Classical example, LIC, premium paid based on the life insurance. Okay, so general deductions which is defined under section 80C to 80U, specified under section 80C to 80U. So deduct that general deductions, then you will arrive at the taxable income. Okay, so this is the way we will calculate the taxable total income and taxable income. So once again, while calculating the total income and taxable income, first you should analyze the assessee to the category of the person to which the assessee belongs to, and his residential status, resident or non-resident, the year for which the income is to be assessed. Then collect all the details of income, classify under different heads, give the specific deductions, ignore the exemptions, sum total, aggregate all the income, get the gross total income, apply the general deductions, then we will arrive at the taxable income. This is all about the taxable income. This is all about the basic learning lessons of income tax. Okay, so while ringing the bells of the previous lessons, we started this basic lesson journey from the term tax, act, income, and later we discussed person, assessment year, previous year, assessee, calculation of total income. Okay, so dear students, be the foundation strong. That is the basic core concept of learning of every subject, not only income tax act. So be the foundation strong and you cement the bricks of knowledge. Okay, that will be useful with the long term. So all the best students, read wide and read deep all the lessons or basic lessons of income tax act.